In finance, valuation is the process of estimating what something is worth. Items that are usually valued are a financial asset or liability. Valuations can be done on assets or on liabilities. Valuations are needed for many reasons such as investment analysis, capital budgeting, merger and acquisition transactions, financial reporting, taxable events to determine the proper tax liability, and in litigation. Valuation overview. Valuation of financial assets is done using one or more of these types of models. Absolute value models that determine the present value of an asset's expected future cash flows. These kinds of models take two general forms: multi-period models such as discounted cash flow models or single-period models such as the Gordon model. These models rely on mathematics rather than price observation. Relative value models determine value based on the observation of market prices of similar assets. Option pricing models are used for certain types of financial assets and are a complex present value model. The most common option pricing models are the Black-Scholes-Merton models and lattice models. Common terms for the value of an asset or liability are market value, fair value, and intrinsic value. The meanings of these terms differ. For instance, when an analyst believes a stock's intrinsic value is greater than its market price, an analyst makes a buy recommendation. Moreover, an asset's intrinsic value may be subject to personal opinion and vary among analysts. The international valuation standards include definitions for common bases of value and generally accepted practice procedures for valuing assets of all types. Business valuation. Businesses or fractional interest in businesses may be valued for various purposes such as mergers and acquisitions, sale of securities, and taxable events. An accurate valuation of privately owned companies largely depends on the reliability of the firm's historic financial information. Public company financial statements are audited by certified public accountants, chartered certified accountants or chartered accountants, and overseen by a government regulator. Alternatively, private firms do not have government oversight, unless operating in a regulated industry, and are usually not required to have their financial statements audited. Moreover, managers of private firms often prepare their financial statements to minimize profits and, therefore, taxes. Alternatively, managers of public firms tend to want higher profits to increase their stock price. Therefore, a firm's historic financial information may not be accurate and can lead to over- and undervaluation. In an acquisition, a buyer often performs due diligence to verify the seller's information. Financial statements prepared in accordance with generally accepted accounting principles show many assets based on their historic costs rather than at their current market values. For instance, a firm's balance sheet will usually show the value of land it owns at what the firm paid for it rather than at its current market value. But under GAAP requirements, a firm must show the fair values of some types of assets such as financial instruments that are held for sale rather than at their original cost. When a firm is required to show some of its assets at fair value, some call this process mark-to-market. But reporting asset values on financial statements at fair values gives managers ample opportunity to slant asset values upward to artificially increase profits and their stock prices. Managers may be motivated to alter earnings upward so they can earn bonuses. Despite the risk of manager bias, equity investors and creditors prefer to know the market values of a firm's assets, rather than their historical costs, because current values give them better information to make decisions. There are commonly three pillars to valuing business entities: comparable company analyses, discounted cash flow analysis, and precedent transaction analysis. Discounted cash flow method. This method estimates the value of an asset based on its expected future cash flows, which are discounted to the present. This concept of discounting future money is commonly known as the time value of money. For instance, an asset that matures and pays $1 in 1 year is worth less than $1 today. The size of the discount is based on an opportunity cost of capital, and it is expressed as a percentage or discount rate. In finance theory, the amount of the opportunity cost is based on a relation between the risk and return of some sort of investment. Classic economic theory maintains that people are rational and averse to risk. They, therefore, need an incentive to accept risk. The incentive in finance comes in the form of higher expected returns after buying a risky asset. In other words, the more risky the investment, the more return investors want from that investment. Using the same example as above, assume the first investment opportunity is a government bond that will pay interest of 5% per year, and the principal and interest payments are guaranteed by the government. Alternatively, the second investment opportunity is a bond issued by a small company, and that bond also pays annual interest of 5%. If given the choice between the two bonds, virtually all investors would buy the government bond rather than the small firm bond, because the first is less risky while paying the same interest rate as the riskier second bond. In this case, an investor has no incentive to buy the riskier second bond. Furthermore, in order to attract capital from investors, the small firm issuing the second bond must pay an interest rate higher than 5% that the government bond pays. Otherwise, no investor is likely to buy that bond, and therefore, the firm will be unable to raise capital. But by offering to pay an interest rate more than 5%, the firm gives investors an incentive to buy a riskier bond. For a valuation using the discounted cash flow method, one first estimates the future cash flows from the investment and then estimates a reasonable discount rate after considering the riskiness of those cash flows and interest rates in the capital markets. Next, one makes a calculation to compute the present value of the future cash flows. Guideline companies method. This method determines the value of a firm by observing the prices of similar companies that sold in the market. Those sales could be shares of stock or sales of entire firms. The observed prices serve as valuation benchmarks. From the prices, one calculates price multiples such as the price-to-earnings or price-to-book ratios, one or more of which used to value the firm. For example, the average price-to-earnings multiple of the guideline companies is applied to the subject firm's earnings to estimate its value. Many price multiples can be calculated. Most are based on a financial statement element such as a firm's earnings or book value, but multiples can be based on other factors such as price per subscriber. Net asset value method. The third most common method of estimating the value of a company looks to the assets and liabilities of the business. At a minimum, a solvent company could shut down operations, sell off the assets, and pay the creditors. Any cash that would remain establishes a floor value for the company. This method is known as the net asset value or cost method. In general, the discounted cash flows of a well-performing company exceed this floor value. Some companies, however, are worth more dead than alive, like weakly performing companies that own many tangible assets. This method can also be used to value heterogeneous portfolios of investments, as well as non-profits, for which discounted cash flow analysis is not relevant. The valuation premise normally used is that of an orderly liquidation of the assets, although some valuation scenarios imply an in-use valuation such as depreciated replacement cost new. An alternative approach to the net asset value method is the excess earnings method. This method was first described in ARM 34, and later refined by the U.S. Internal Revenue Service's Revenue Ruling 68-609. The excess earnings method has the appraiser identify the value of tangible assets, estimate an appropriate return on those tangible assets, and subtract that return from the total return for the business, leaving the excess return, which is presumed to come from the intangible assets. An appropriate capitalization rate is applied to the excess return, resulting in the value of those intangible assets. That value is added to the value of the tangible assets and any non-operating assets, and the total is the value estimate for the business as a whole. Usage. In finance, valuation analysis is required for many reasons, including tax assessment, wills and estates, divorce settlements, business analysis, and basic bookkeeping and accounting. Since the value of things fluctuates over time, valuations are as of a specific date, like the end of the accounting quarter or year. They may alternatively be mark-to-market estimates of the current value of assets or liabilities as of this minute or this day for the purposes of managing portfolios and associated financial risk. Some balance sheet items are much easier to value than others. Publicly traded stocks and bonds have prices that are quoted frequently and readily available. Other assets are harder to value. For instance, private firms that have no frequently quoted price. Additionally, financial instruments that have prices that are partly dependent on theoretical models of one kind or another are difficult to value. For example, options are generally valued using the Black-Scholes model, while the liabilities of life assurance firms are valued using the theory of present value. Intangible business assets, like goodwill and intellectual property, are open to a wide range of value interpretations. It is possible and conventional for financial professionals to make their own estimates of the valuations of assets or liabilities that they're interested in. Their calculations are of various kinds, including analyses of companies that focus on price-to-book, price-to-earnings, price-to-cash flow and present value calculations, and analyses of bonds that focus on credit ratings, assessments of default risk, risk premia, and levels of real interest rates. All of these approaches may be thought of as creating estimates of value that compete for credibility with the prevailing share or bond prices, where applicable, and may or may not result in buying or selling by market participants. Where the valuation is for the purpose of a merger or acquisition, the respective businesses make available further detailed financial information, usually on the completion of a non-disclosure agreement. It is important to note that valuation requires judgment and assumptions. There are different circumstances and purposes to value an asset. Such differences can lead to different valuation methods or different interpretations of the method results. All valuation models and methods have limitations. Model inputs can vary significantly because of necessary judgment and differing assumptions. Users of valuations benefit when key information, assumptions, and limitations are disclosed to them. Then they can weigh the degree of reliability of the result and make their decision. Valuation of a suffering company. Additional adjustments to a valuation approach, whether it is market, income, or asset-based, may be necessary in some instances, like excess or restricted cash, other non-operating assets and liabilities, lack of marketability, discount of shares, control premium or lack of control discount, above or below market leases, excess salaries in the case of private companies. There are other adjustments to the financial statements that have to be made when valuing a distressed company. Andrew Miller identifies typical adjustments used to recast the financial statements that include working capital adjustment, deferred capital expenditures, cost of goods sold adjustment, non-recurring professional fees and costs, certain non-operating income, expense items, valuation of a startup company. Startup companies such as Uber, which was valued at $50 billion in early 2015, have a valuation based on what investors, for the most part venture capital firms, are willing to pay for a share of the firm. They are not listed on any stock market, nor is the valuation based on their assets or profits, but on their potential for success, growth, and, eventually, possible profits. The professional investors who fund startups are experts, but hardly infallible. C.com bubble. Valuation of intangible assets. Valuation models can be used to value intangible assets such as for patent valuation, but also in copyrights, software, trade secrets, and customer relationships. Since few sales of benchmark intangible assets can ever be observed, one often values these sorts of assets using either a present value model or estimating the costs to recreate it. Regardless of the method, the process is often time-consuming and costly. Valuations of intangible assets are often necessary for financial reporting and intellectual property transactions. Stock markets give indirectly an estimate of a corporation's intangible asset value. It can be reckoned as the difference between its market capitalization and its book value. Valuation of mining projects. In mining, valuation is the process of determining the value or worth of a mining property. Mining valuations are sometimes required for IPOs, fairness opinions, litigation, mergers and acquisitions, and shareholder-related matters. In valuation of a mining project or mining property, fair market value is the standard of value to be used. The simple standards are a recognized standard for valuation of mining projects and is also recognized by the Toronto Stock Exchange. The standards, spearheaded by K. Spence and Drive, W. Roscoe, stress the use of a cost approach, market approach, and the income approach, depending on the stage of development of the mining property or project. Depending on context, real options valuation techniques are also sometimes employed. For further discussion here see business valuation, option pricing approaches, corporate finance, valuing flexibility, as well as mineral economics in general, asset pricing models. See also modern portfolio theory, capital asset pricing model, arbitrage pricing theory, Black-Scholes, fuzzy payoff method for real option valuation, single index model, Markov switching multifractal.